welcome back to this week's market update. Today is Monday, January 13th, 2025, and with that, we will jump right in. Last week was shaped by Thursday's market closure in honor of the late President Jimmy Carter, followed by a stronger than expected employment report on Friday that sends stocks lower, as you can see here. So the market is really looking for a little bit of softer economic data, stable but soft. So that makes the way for the Fed to continue cutting rates this year. But with this stronger economic data, that means the Fed may likely be more hesitant to cut rates in 2025. So that ultimately sent stocks lower for the week. We saw as of Friday, January 10th, the S&P 500 down about 1.9%, as well as the Dow Jones Industrial Average also down about 1.9%. The Nasdaq Composite down a little bit further at 2.3%, down for the week. And then the Barclays Aggregate Bond Index down about 0.9% as interest rates rose due to the stronger jobs data. What exactly was that stronger than expected jobs report? Well, taking a look right here, we saw the unemployment rate fall to 4.1%. So originally the expectation was that it would stay steady at that 4.2% level that it was in November, but instead it fell. And another surprise here was the non-farm payroll gain. So this was expected to be well below 200,000. It completely exceeded expectations at 256,000 jobs added in the month of December, much higher than expectations, with job growth driven by healthcare, government, social assistance, retail trade, and leisure and hospitality. So a lot of public services there, but also some private services, which are a good indicator of the economy growing. We saw wage growth rise 3.9% year over year, so that outpaced inflation, and the average hourly work week held steady at 34.3 hours for the fifth consecutive month. So overall, a very strong month of employment in December. Now, looking a little bit further at why this was a negative, why was strong economic data a negative for the market last week? Well, the primary concern is rate cuts. So when economic data is really strong, that means that the Fed is more likely to keep rates higher for longer, and equity markets are really looking for rate cuts. So with a lower chance of rate cuts, that is what sent the market lower last week. You can see this in the numbers here. The light blue is a week ago, and then the darker blue is today, January 13th. The chances of no rate cuts almost doubled in the last week, going from 16% to almost 30%. So the chances of no rate cuts in 2025. Now, these are just market probabilities. This is not fact by any means, but that rose quite a bit. Even the chances of just one 25 basis point rate cut, that rose as well, while the chances of 2 rate cuts fell, the chances of 3 rate cuts fell, and the chances of 4 rate cuts fell. So the market is really expecting the 0 to 1, maybe even 2 rate cuts in 2025. And that would also coincide with the Fed's projected 25 basis point rate cuts in 2025. So the employment report was by far probably the biggest event in the markets last week, but we also had several other economic data points that came out, including the ISM Services Index. This rose to 54.1, so from a pretty slightly bullish number here to a more bullish number in December. And that was driven by an increase of the Business Activity Index. That's at 58.2%, reflecting a lot of strong current activity in the services sector. We also saw the new orders index at 54.2%, so a lot of growth in demand as well. And then finally, the employment index, all of these being components within this total services PMI employment index at 51.4%. So that's also strong, slightly bullish, a little bit less bullish than things like the business activity index, but all of this shows pretty strong dynamics in the services sector. Shifting gears into some more consumer-focused data, we got the Consumer Sentiment Index for the month of January from the University of Michigan. This showed a very small decline from the upward trend that we were in prior to January. It was down 1.1% in the month of January, and sentiment was down 7.3% from a year ago. So a little bit of a decline year over year, as well as in the month. We saw that assessments of personal finances showed an improvement, rising 5% in the month. However, this was offset by a 7% drop in short-term economic outlooks and a 5% drop in long-term economic outlooks. So a little bit better household finances, but overall outlooks on the economy that's cooling a little bit from this increase in sentiment that we saw in the 6 to 12 months prior. We also saw heightened concerns over inflation expectations climbing from 2.8% in December to 3.3% in January. And this was the highest level of inflation expectations since May of 2024. Last but not least, we also got consumer credit data from the month of November. So a little bit of a lag, but it's still great to look at. It gives us a lot of insights on how consumers are taking out and paying off debt. Essentially, consumer credit outstanding here is a proxy for consumer debt that is in the US. So here we can see it fell 1.8% from a year ago. So that's pretty a good sign. It can be mixed because when consumers are paying off debt, maybe they have more conservative views about the economy moving forward, that they need to pay off their debt now so that they will be safer in the future. Alternatively, this could mean they're investing less in things like education. Maybe they're not buying a new car, they're delaying that, things like that. But it could also mean that their household finances are getting better because they are paying down their debt. So a lot of mixed data there. But looking a little bit further at this drop, it came down to a 12% drop in the amount of revolving credit outstanding. So this includes things like credit cards, personal lines of credit, those revolving credit that consumers can kind of use at their leisure when they're short on cash. That was down 12% from a year ago. So that's quite a big drop from a year ago. You can see that that's been increasing in the months prior. Very interesting here, especially as we entered the holiday season in November. Alternatively, just looking at some of the average interest rates on these loans, we can see that a 60-month car loan, that's been pretty stable. It's up to 7.8% right now. Credit cards at about 21.5%, and personal loans at about 12.3%. So interest rates remain pretty high. So that concludes this week's market update. We thank you so much for tuning in, and we look forward to seeing you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.